Hi investors, it's Nick here, and today I'm just going to talk about mortgage rates, deals that work, and just some new information about Gatehouse Bank. So the very first thing is I've been talking with my favorite mortgage advisor, David Eva, and he's received an announcement from Gatehouse saying that they will be back in the market in November. They didn't specify when in November, so let's assume late November instead of early November. And we were just discussing the kind of interest rates that we might expect. Now, the caveat to all of this is I'm not a mortgage advisor. People like David Eva, they're mortgage advisors, and they are the ones that give you specific mortgage advice. But I am an interested party in that I like to know my numbers, and I built a simulator, a big calculator thing, which helps me work out the true purchase cost of property and what numbers basically work. And I thought this might help you by doing some scenarios and seeing what actually works. So with that in mind, I'm going to share my screen and I'll explain roughly what's going on. I have this calculator I built. Here we go. And this is a pretty complex calculator, and it allows me to do numerous scenarios, which is helpful. And then I can do a report, and then clients can look at all the different scenarios with different cash flow and different whatever and future casting and so on. It was really it's really the ultimate scenario investigation tool, I suppose you could say. Anyway, I'm not going to bore you with all of that because it's probably too much detail. So what I did was I went through the calculator earlier and pulled together some numbers, and from there we can get a general sense of what's going on. So David and I, the speculation is that interest rates might be around, say, 7%. Hampshire Trust Bank are offering 8%. So let's say that the Bank of England hold their interest rate, base interest rates, don't raise them, and the markets all settle down because the new UK government actually understands a bit about economics, and therefore markets are reassured, and thus the risk premium that's built into market prices is reduced, thus the cost of borrowing money reduces. That's a very simplified version of it, but essentially banks have to borrow money. They wholesale money. They borrow money at a price, and then they lend money out at a higher price, and the gap is their profit plus their risk margin and so on. But the price they borrow money at also has a risk margin above the base interest rate. And right now that risk margin is really high, and therefore markets are nervous, right? But they're calming down, so this is good. So let's assume 7%, and let's assume that Gatehouse and all the other main lenders stick to what seems to be a standard £100,000 minimum mortgage size. Now, Gatehouse Bank started offering £75,000 mortgages around 5 months ago, I think it was. And then 2.5 months later, or thereabouts, give or take a week or two, a little bit later, they said, we're pausing new business for now. We're for whatever reason. And the reason was probably to clear backlog, improve processes and workflows, and just be more efficient when they reopen. But the thing was, when they went to 100,000 or 75,000 pounds, as I say, they had a flood of applicants. I know, because loads of my clients applied for these smaller sub £100,000 mortgages. Now, back in the summer, when interest rates were around 5% with Gatehouse, you could make a property deal work at the kind of yields that we still see. And the reality is that yields aren't really going up, and therefore what I wanted to do is answer a question, which is, given these circumstances, 7% interest rates plus minimum mortgage £100,000, what deals work? Well, if you've been reading through this as I've been talking, you'll know. And in my experience, we're seeing quite a lot of 7.17% yielding properties at around the 100,000, 110,000 mark. But what's actually happening is that when you start to creep up to 135,000, which is what you need in order to get your minimum £100,000 mortgage at 75% loan to value, then the yields drop down to about 6.5%, that kind of thing. So there's genuinely a linear correlation between price and yield. Price goes up, yield goes down. Now, this assumes consistent risk. And so what a lot of investors don't think about is risk. And the reason they don't think about it is because it's difficult to quantify. How can you quantify that an economy property in a really bad area is high risk versus a mid-priced property in a really nice area? And the answer is you can't really quantify it, and therefore you just have to go with some basic assumptions, which are that poorer people are more economically vulnerable, and therefore if times are difficult, they're more likely to not pay their rent and more likely to play the system, let's say, in their favor because they're impoverished, and end up in your property for a very long time whilst you try and evict them. So there's high risk, low risk. And based on our collective experience as a team, there are just certain properties in certain areas that work. So let's say low risk, you can get relatively low risk investments at around 7%, but you have to be purchasing at a lower price. So at £135,000, there will be compromises if you're getting a 7.1% yield. And it'll be something like bad location or location like backing onto a motorway or railway or whatever. But then the problem you have is buyers or renters will only want to rent that property if for some reason they're slightly compromised, i.e. they don't have enough money to rent a more expensive, more pleasant place, or they've got some sort of issue with credit history or something wrong, or their employment isn't so good or whatever. Compromises. And this investment game is all about understanding what compromises there are and how you can work things through so you don't suffer major compromises. Anyway, right. So the upshot is that it's very difficult to get 7.1% yield. Now, I'll show you what I'm talking about. I have some example properties which just give you an idea of what the market is like. Now, just to explain, the way it works is we get all the properties from all the portals, we analyze them algorithmically, then we have 3 analysts who then manually review them, and then the properties that make it through are the ones that we share with our investors via our WhatsApp group. Now, for example, this one's £140,000 and it's in, let's see, just have a look at this. It's in Warrington, I think. Crewe. Right. So Crewe is it's okay. It's not especially good for future capital growth prospects. Demographic isn't great. There's a lot of private rented accommodation, but you'll still be able to rent a property like this. Just, it's not as great as an investment as you might have in, say, an area around the Greater Manchester catchment. But here you go. It's going to need some work and it's in passable condition. So it needs painting, decorating. It's quite a large property, which in some way doesn't really work. The catch with these large properties is they're expensive to maintain because you've got more square footage to deal with, basically. And anyway, without getting into the depths of a property as such, The point being that that I need to get that back. Here we go. Yeah, so the point being that sorry, just trying to make this work. The point being that economy properties, it's difficult to get a yield of more than 6.3%. So the deal doesn't actually work as such. And therefore, you're a bit stuck. So let's say you can't get that 6.1. You're getting 7.1. You're getting 6.4, for example. Then you've got to look at where you can break even. And the next break even, arguably, is somewhere around £170,000. And that's because at that level, you can go lower loan to value and still get your £100,000 mortgage. But the yield will be lower. So this is the trick, to get those high yielding properties at the right price in order to be able to fulfill your core requirement of minimum mortgage size £100,000. Anyway, the catch with this is you go up to £170,000 and then you're spending nearly twice the amount of money to own a property that's still just going to break even from a cash flow point of view. And therefore, the business model goes from making money to making cash flow money to capital gain. Well, the current push in the market is over for now, and we might be waiting 10 years to get back to this. So this is a bit of a conundrum, because that's not really a great cash return, assuming properties go sideways for a number of years. And it's a problem. So then we're on to the next question. Well, okay, what if Gatehouse offer £75,000 mortgages once again? Then everything can kind of work. So you would have to get a minimum property price of £100,000. You can easily achieve 7.1% yield or more, sometimes 7.5%. And let's assume you go at 75% loan to value, your investment is £30,000 and you own a house. So at that level, everything's good. But we don't know. And we don't know what Gatehouse are going to come back into the marketplace with. There is another company called Octopus Real Estate. They offer minimum mortgages of £50,000. So even if they come in at 7% or whatever, then the deal can work. But they're not open for business right now. So who knows what's going to happen there. Broadly, it's all a bit messy. And as I say, I kind of don't really know what to say, other than we've got to wait till the banks get back to the market, see what the interest rates are going to be like, what the minimum mortgage sizes are going to be, and then we go from there. One thing I am investigating is local authority renters. So what happens is that local authorities will rent properties because they're desperate for property stock, and the yields are somewhere around 8 to 10%. I've done some research into it. The general landlord community doesn't like them, but the fact is these things exist, and there are landlords who rent to local authorities, and I think it's all down to subject-specific knowledge. So anyway, it's an area that we're going to look into and see what we can find, but the paradigm will shift from what has worked really well, which is nice properties, nice demographics, real opportunity for capital growth, to terrible demographics, long-term deprivation, but good cash flow. And for a lot of investors, I think everything's boiling down to this question. Do you want to wait for the next up cycle in the property cycle, which could be 10 years from now? Or would you rather go for the cash flow? And I think the general sense I'm getting from investors is they would rather go for the cash flow. For me, I would rather go for lowish cash flow and far higher capital gain prospects, because I'm not really looking for the payday today, and I'm prepared to wait. And I also know that once my interest rates are locked in, rents generally increase in line with inflation, and therefore over time I get more and more cash flow out of my portfolio. So it's really choices, that's all. What choices you're prepared to make. But for just regular mortgages and so on, the jury is totally out. I have no idea how this is going to pan out. But right now at 7%, well, there is one bank offering 8%, that's Hampshire Trust. No deal works with them unless you go very low loan to value. In other words, 50% loan to value on a property that might be £200,000. But then you sink an awful lot of money into the property and you get a very marginal rate of return. But you do have the benefit of good potential capital gain upside in the future. Anyway, I hope that's some help. It's an interesting time. On a final note, we do have quite a lot of clients who are creeping out of the woodwork, who are buying for cash. The pound is still fairly weak against the Hong Kong dollar. That's a good thing for them. And there's still a lot of value. The market hasn't collapsed by any means, but it's in a state of semi-paralysis as everyone's just waiting for banks to settle down, interest rates to settle down. And then what I expect will happen is that there will be pent-up demand, and then the market will just kind of crank into action again. And those people who are absolutely desperate to buy will buy. And thus the market will carry on and prices will basically hold up. That's how I'm seeing it at the moment. Of course, these things change, and they change, of course, by the actions of the Bank of England and the LIBOR bank lender, the interbank lending rate. Anyway, there we are. Thank you very much.